Welcome back to another episode as we dive into more financial statements. Today, we're going to be looking at and talking about cash flow statements. Cash flow statements are pretty much the financial roadmap that shows us how money moves in and out of a business. If you want to know how to keep these dollars flowing in the right direction, this episode is for you. So, what exactly is a cash flow statement? Think of it as a financial dashboard that gives us a detailed view of a business's cash movements during a specific accounting period. It's like your car's dashboard, but for money. It lets you know if everything's running smoothly or if you're about to run out of gas. It's important because it shows the company's ability to manage both short term and long term financial operations. It lets you know how they're dealing with the dinero. So the cash flow statement is split into three main parts. The first part is cash flow from operating activities. The second part is cash flows from investing activities. And lastly, it's going to be cash flow from financing activities. Each part tells its own story about where the money's coming from and where it's going. So let's look at the operating activities. This is where the everyday action happens. It's all about the cash that's generated from the company's core business operations. It's going to include everything from income to expenses. Basically, all the cash that flows in and out while keeping the business running. Now, you also have investing activities. This is where it's about buying and selling assets. So think of it like the company going on a shopping spree or selling off some of its stuff. It covers transactions like acquiring real estate, vehicles, or even patents. Basically, investing in things that can generate future income. And finally, the third piece of it is financing activities. This is how the company funds its ventures. This part is going to show the cash movements related to debt and equity financing. It's like the company's financial heartbeat, revealing how it borrows or raises money to fuel its operations. So real quick before we get ahead of ourselves, a lot of times a cash flow statement is going to be seen in companies or businesses that are public. So when you're buying a business, you're probably going to be seeing a lot of cash flow statements. If you're going to be evaluating public companies, you're going to see cash flow statements. A lot of times you're going to see this in a smaller form when you're looking at properties, because a lot of times properties don't have a lot of investing activities unless you're a really savvy investor where there are capital that's set aside from the property that are used to be invested elsewhere that generates capital, or if that money is being used to as a funding source for another venture or a loan for some way, shape, or form. Usually that's when you see all three parts of the cash flow statement. Generally, you're only going to see the operating activities, so keep that in mind. Another thing I want to touch on is cash flow versus profit. It's a common confusion. Cash flow is the actual cash moving in and out of the business, like we've talked about when it comes to cash flow statements. It's tracking the movement of the money. Profit, on the other hand, is what's left after all the expenses are deducted from the revenue. It's the bottom line that you're going to see on your income statement. So while cash flow is all about liquidity, profit is more about the overall financial performance. In the real estate world, you're going to hear investors talk about cash flow per month, cash flow per year, and they're going to be referring to profit. It's kind of a slang term, if you will, that we're using in the real estate world versus the traditional accounting finance world. I'm not a stickler here. I don't think anybody's a stickler here, but I'm just letting you know in order to know the difference so that you don't get wrapped up when you're having conversations about real estate investments, etc. Now, when you're diving into the cash flow statement, you can pinpoint the exact activities that bring in cash. This knowledge is gold because it helps you make smart financial choices. Ideally, the cash flow from daily operations should consistently surpass the net income. A positive cash flow is a sign of great financial strength, and it suggests that the business has room for growth. But here's the kicker. Positive cash flow doesn't always mean that the company is profitable. That's why it's super important to look at the cash flow statement along with the balance sheet and the income statement. It's like piecing together a puzzle. Each document is going to give you a different part of the picture in order to get you the whole Mona Lisa. Once again, to really understand a company's financial health, you're going to have to connect the dots between all of the financial documents. In a previous episode, I've talked about balance sheet. In another episode, I've talked about income statements. So you got to piece the information from all three of those together in order to give you the complete view of the company's financial position and or performance. If you ever feel lost in the numbers, like me, a lot of times reach out to your accountant. Hopefully he's a badass. Hopefully he's a killer and he can give you some advice to navigate through those numbers and what they're actually telling you. Because at the end of the day, they're your GPS through the financial maze. And that's all I have for you guys today on cash flow. Remember, understanding financial documents is like having x-ray glasses. You get to see exactly how the investment is doing, the whole financial picture, and how money is moving. It's super important for you to understand all three together, whether you're buying businesses, whether you're buying just real estate. It's a good idea to start to learn how to read them now. Thank you for tuning in, and I will catch you guys next week.